They waited until you were asleep. That is not an exaggeration. That is not a metaphor. It is an old tactic, a cowardly tactic, but an effective one, or at least it used to be. Last night, while New York was dark, and while London was just pouring its first cup of coffee, while retail traders were asleep and newsrooms were quiet, the most dangerous weapon in the financial arsenal was deployed. They didn't sell metal. They didn't announce a new mine. They didn't fix the supply chain. They didn't solve the shortage. They changed the rules of the game. If you woke up this morning, checked your phone, and saw red candles, if you saw silver suddenly smash down from its highs, if you felt that familiar pit in your stomach, that old fear creeping back in, and that here we go again feeling, stop, breathe. Because what you are looking at is not a market crash. What you are looking at is an act of desperation. Overnight, the exchange, the entity that is supposed to be a neutral referee, stepped in and raised margin requirements on silver futures, not by a little, by 50%. In a single move, they made it dramatically more expensive to hold silver positions than it was just yesterday. They tried to force liquidation. They tried to trigger a long squeeze. They tried to break your spirit before the weekend. But here's the part they didn't expect. Here's the data point that should terrify JP Morgan and delight anyone holding physical metal. It didn't work. In 2011, when they did this, silver collapsed 30% in a week. In 1980, when they did this, silver collapsed 50%. Today, the price flinched, it dipped, and then it stood its ground. In this investigation, we're going to expose what a margin nuke really is, the exact historical playbook they are reusing, word for word, why volume data from this morning proves the smart money didn't sell, and why this failed attack marks a turning point in silver history. The banks fired their silver bullet, and the werewolf is still standing. This is the story of the Friday showdown. Understanding the casino. To understand why the market is red today, you first need to understand the casino, because most people still believe the price of silver is determined by two people swapping a coin. It isn't. The global price of silver is determined almost entirely by futures contracts, paper promises traded by speculators. These contracts are not backed ounce for ounce by metal. They are leveraged bets. Until yesterday, if you wanted to control 5,000 ounces of silver, you didn't need $300,000. You needed about $12,000. That's roughly 25 to 1 leverage. This leverage is what allows prices to rocket upward. But it is also the kill switch, and the exchange controls it. Here's what happened overnight. At around 2 a.m., the CME group issued a notice. Margin requirements for silver futures were raised by roughly 50%. Let's simplify what that actually means. If margin goes from $12,000 to $18,000 per contract, it doesn't sound dramatic until you scale it. Imagine you are a hedge fund holding 1,000 silver contracts. Yesterday, you needed $12 million in cash. Today, the exchange says you now need $18 million. You have 1 hour, wire $6 million, or we sell your position for you. Where do you get $6 million at 2 a.m.? You don't. So the exchange's computers step in and automatically sell your contracts at market price. Not because you wanted to sell, not because fundamentals changed, not because demand disappeared, because the house changed the buy-in. That is a margin nuke, the designed cascade. The margin nuke is not accidental. It is designed. It flushes out leveraged players, the weak hands, and when those players are forced to sell, the price drops. That drop triggers panic selling from others, which triggers more liquidations, which creates a cascade. That was the plan. That's exactly what they did in May 2011. In that month, the CME raised silver margins 5 times in 9 days. They increased the cost of betting on silver by 84%. The result? Silver fell from $49 to $33. They beat the market into submission, and now they are trying the same thing again. They saw silver break above $60. They saw vaults emptying. They saw Bank of America bleeding, and they pulled the same lever, raise margins. But this time, the result was different. Why it failed? Why didn't it work? Because the buyers of silver in 2025 are not the same buyers from 2011. Back then, silver was a speculative trade. Today, it is an industrial necessity. Tesla does not buy silver on margin. Samsung does not buy silver on margin. The Indian government does not buy silver on margin. They pay cash. When the exchange raises margin requirements, these buyers are untouched. They don't get liquidated. They don't panic. They step in and buy. This is why silver only dipped cents, not dollars. The margin nuke only kills paper speculators. It does nothing to physical demand, and today the market proved that physical buyers now control the floor. 2011 vs 2025. Let's go back to May 1st, 2011. Silver had gone parabolic. Vaults were full, supply was available, the rally was driven by paper demand. So when paper demand died, the price collapsed. Now look at 2025. We have a 1.1 billion ounce deficit. Vaults are drained, refineries are stalled. Delivery times are exploding. This rally is driven by physical depletion. You cannot margin hike a shortage. You cannot paper bomb geology. The margin nuke is a paper weapon, but this is a physical war, and today's price action proves it. The bear trap. So what did the margin nuke accomplish? It created a bear trap. Here's how it works. Price dips below $64. Retail traders panic. They sell. Some even short. But who buys? Not retail. Retail panics on red days. The buyers were algorithms, industrial firms, sovereign funds. They were waiting. Ownership transferred from weak hands to diamond hands. Now the price floor is stronger than before. And when the price turns up, the shorts are trapped. Forced buying becomes fuel. The margin nuke didn't kill the rally. It reloaded the cannon. The Friday fear. Why did this happen on a Friday? Because the banks are terrified of the weekend. The COMEX closes. Paper control shuts off. Asia wakes up. If silver closes Friday strong, it signals the West has lost control. So they painted the tape red. But here's the irony. They just put a sale sign on silver right before Asia opens. China sees margin hikes as weakness, and weakness invites attack. The shadow order book. Why didn't the price collapse? Because of the shadow order book. Industrial buyers have standing orders. Below $64 buy 1 million ounces. Below $63 buy 2 million ounces. These orders are invisible, but you can see their effect. Every dip gets swallowed. And once industry buys silver, it never comes back. That metal is gone forever. The float shrinks, the floor rises. Paper manipulation accelerates physical drain. The banks are helping their enemy. The last cards. If margin nukes don't work, what's left? Two options. Position limits, force large holders to sell, or liquidation only mode, turn off the buy button. If they do that, paper silver could crash, but physical silver would explode. The spread would blow out. The COMEX would die. They are trapped. And today proved it. Why you hold silver? Ask yourself, are you holding silver to make more dollars? Or because the dollar is broken? Because today was noise. Physical truth hasn't changed. Geology, energy demand, debt. Paper contracts are promises from bankrupt institutions. Physical silver is a claim on reality. The margin nuke was a test. Did you panic? Or did you recognize a discount? Monday. Here's my prediction. The shorts are trapped. Weekend panic will build. Asia will respond. Monday opens higher. $65, $66. Forced covering begins. The path to $70, $80 opens. The banks fired their best shot, and they missed. Friday, December 12th, 2025. The margin nuke failed. The old rules are gone. Scarcity now sets the price. If you hold physical silver, sleep well. 1 ounce is still 1 ounce. And it is becoming more valuable every day. Stay stacked, stay strong, ignore the noise. I'll see you on the other side of the gap. Subscribe.